Welcome back to the deep dive. We are jumping straight in today because we're looking at a really critical moment for digital assets.
That's right.
We've spent time digging into a pretty detailed market analysis report, specifically focused on, the outlook for late September 2025.
hmm
And it feels like a tale of two cities right now. You've got this powerful upward price movement clashing almost with these
Well,
huge structural regulatory shifts on the horizon.
that sums it up perfectly. And our mission today is basically to unpack all of that. We want to pull out the most important drivers, the risks you need to be aware of, and maybe some immediate opportunities for you, the listener.
Okay.
So we'll focus on three main things: Bitcoin's current cycle, where it is, the volatility, then the huge potential impact of stablecoin regulation, and finally, what specific macro and regulatory events are happening, like right now this week.
Great. Let's kick off with the big one then, Bitcoin, the price action. I mean, it absolutely ripped through the summer, didn't it? Recovered from that low back in April. What was it, $74,400?
Yeah, around there. Yeah. A multi-month low at the time.
And now, bang, a new all-time high. Just cracked $105,000 recently. So on the surface, you'd think, okay, pure bull mode activated.
Certainly looks like euphoria, yeah. But we have to immediately add a strong note of caution here.
Okay.
Analysts, and notably those from Fidelity Digital Assets, they're raising a very clear yellow flag. Their analysis suggests this current bull market might be entering what they call its final acceleration phase.
The final acceleration phase. That phrase sounds ominous. We've heard it before, right? Usually means the party might be ending soon.
Why is Fidelity's warning so significant now? I mean, isn't volatility normal when you hit new highs?
It is normal, absolutely, but context is everything here. When a major player like Fidelity uses that specific language, they're usually looking at historical patterns, key on-chain metrics, things like the MVRV ratio or big spikes in retail buying. They're seeing signals reaching levels last seen just before the major corrections in, 2017 and 2021.
Ah, okay, so it's pattern recognition. Exactly.
Yeah.
This phase is typically marked by extreme optimism, maybe too much leverage in the system, and then one final massive price surge, which is often followed by a pretty severe, sharp correction. So even with prices looking great, extreme caution is the word.
Got it. Caution flagged. But despite this short-term warning about maybe hitting a peak, what's actually fueling the underlying sort of structural long-term optimism? Why does capital keep flowing in?
Well, it really boils down to institutionalization. Two huge forces at play. First, corporate adoption. It's not niche anymore. The report we looked at highlighted over 75 public companies now have Bitcoin reserve strategies officially on their balance sheets.
75, that's moved beyond just the early tech adopters.
Yeah, definitely. It represents a steady, reliable source of demand that simply wasn't there in earlier market cycles. It's maturing.
Okay, that's the corporate side. What about the nation-state angle? We've heard whispers about that.
That's potentially the next even bigger wave. We're seeing, let's say, early stage signals, indications that several other countries are seriously considering setting up strategic crypto reserves,
Right.
Following the lead of the early mover.
Right.
Now, think about this. If even just a few medium-sized sovereign wealth funds decide to allocate, say, 1% or 2% to Bitcoin, the demand shock from that could dwarf what we've seen from corporations so far.
Wow. Okay, that's a potential game changer. Let's zoom back in, though, to the immediate picture, the next to, say, 24 to 48 hours before some of this bigger news potentially hits. What are the technicals suggesting for price action?
High volatility is basically the baseline expectation right now. From a technical standpoint, analysts are watching support levels. There's a possibility of a quick dip, maybe towards $94,334 if the market gets nervous, and crucially, if that Bitcoin dominance metric keeps climbing.
Okay, we'll get to dominance in a sec. What about Ethereum in this immediate picture?
The expectation is that ETH might actually underperform Bitcoin in the very short term.
Why would that be? Given all the activity on Ethereum, the ecosystem strength.
It often comes down to sort of a risk-off reflex within crypto itself. When there's general uncertainty, even during an all-time high run like this, capital tends to flow towards Bitcoin. It's seen as the relatively safer haven within the crypto asset class.
Right, the digital gold narrative playing out.
Exactly. So that rotation puts temporary pressure on altcoins, and that includes ETH.
But I thought the supply metrics for ETH looked incredibly bullish. Like, supply on exchanges is way down. That seems to contradict the idea it might underperform.
And that's the tricky part. It is a contradiction, but it's rooted in liquidity risk. You're right, the amount of ETH held on exchanges has plummeted down something like 52%. That usually is a strong sign of conviction. People are moving it off to hold long-term, maybe stake it, use it in DeFi. However, that low supply on exchanges also means thinner order books, less liquidity. So if there is a sudden price drop, there's a much higher risk of cascading liquidations. Especially if the price breaks below a key level, the report flagged around $3,700 as important support for many leveraged positions.
ISIS. So fewer buyers immediately available on exchanges to absorb big sell orders if that level breaks.
Precisely. High conviction, yes, but potentially thin ice if sentiment shifts quickly.
Okay, that clarifies the risk. This is exactly why we need solid data points to track what's really happening. And you mentioned the report flags some specific indicators for market health. This is where it gets really interesting for navigating this phase.
Absolutely. Data is crucial now.
Yeah.
The first indicator you absolutely have to watch is BTC Dominance. Right now, it's sitting around 57.8%.
Right. And just a quick refresher for everyone, that 57.8% basically means Bitcoin makes up almost 58% of the entire crypto market's value.
Exactly. Think of it as a gauge of market confidence, or maybe fear. If we see that dominance number surge higher, let's say towards the 61%, 62% range, that's a very clear signal. It means capital is actively fleeing altcoins and rushing into Bitcoin.
Which is bad news for everything else.
Creates massive downward pressure on the rest of the market, yeah.
Okay, indicator 1, BTC Dominance. What's number 2?
Number 2 is a classic, the Fear and Greed Index. It's currently showing a reading of 37. That falls into the fear category. It's actually up a little from 33 yesterday, but still firmly in fear territory.
Interesting. Even with a new ETH, the market is still scared.
It seems so. This persistent anxiety, this fear, it acts like a kind of psychological brake. It limits those really strong, impulsive upward moves. We know the saying, right? Extreme fear can be a buying opportunity. Extreme greed often signals a top. Right now, despite the price, the underlying mood is still quite anxious.
Okay, fear and greed at 37. And the third key indicator, this one tracks the big money, right?
That's the one. Tracking ETF flows. Monitoring the daily net inflows and outflows for the spot Bitcoin ETFs. This has become probably the single most important gauge of what institutional investors are doing.
Are they buying the dips? Selling the rips?
Exactly. Are these large funds using the volatility to accumulate more Bitcoin, showing long-term conviction? Or are they starting to de-risk, taking profits off the table? Their actions provide a huge clue about the stability of these higher price levels.
So if we put those three together, dominance, fear and greed, and ETF flows, what's the overall trading outlook, especially for the altcoin market? Let's say based mainly on that dominance indicator.
Well, right now it feels quite binary, almost like a fork in the road. If BTC dominance breaks higher, pushes past resistance, and keeps rallying towards that 61-62% area, then you should probably expect a fairly broad correction across the altcoin space. If, however, dominance gets rejected at its current resistance level, maybe starts to trend downwards, that could signal returning confidence in the broader market. And that might be the trigger for a mini altcoin season, where capital flows back into some of those higher risk, high reward plays like Solana, Avalanche, maybe Polygon, etc.
Got it. A clear pivot point to watch. Okay, we've covered the price action, the volatility risks, the metrics. But like you said earlier, maybe none of this matters as much long-term without the right regulatory foundation. So let's pivot to stablecoins. They really are the bridge between traditional finance, TradFi, and DeFi, aren't they?
They absolutely are. And what's really fascinating, and I think still underappreciated, is the sheer scale they've already reached. The analysis highlights that stablecoins are effectively acting as the, quote, backbone of the global remittance system.
Backbone of global remittance.
Okay, get this, to put that scale into perspective. The transaction volume for stablecoins in 2024 has already surpassed the combined transaction volume of Visa and MasterCard.
Wait, say that again? Surpassed Visa and MasterCard combined already.
Already. This year's volume, it's an astonishing statistic. It shows just how much value is moving via dollar-pegged digital assets, even before we have full regulatory clarity in major markets like the U.S.
Yes. Wow. Okay, that completely reframes the importance. No wonder regulation is becoming such a hot topic.
Precisely. That scale basically forces the issue, and that's why clear legislation, specifically this proposed Genius Act, is reportedly a high priority for the current administration. They're aiming for the first half of 2025. This clarity is arguably the single biggest structural tailwind the entire crypto industry is waiting for.
The Genius Act. We've heard about it. It seems like it's been debated for years. Does the report give any clues as to why it might actually have legs this time? Why the political momentum now?
It seems to be a convergence of factors. First, that sheer economic reality, the transaction volume we just discussed, It demonstrates a clear need and utility that's hard to ignore. Second, there's increasing adoption of stablecoins globally, including by major U.S. allies. The U.S. doesn't want to fall behind on payments innovation.
Right, the competitiveness angle.
And third, the proposed legislation seems to be framed in a way that addresses key concerns around national security and anti-money laundering. That gives it broader appeal, potentially across political lines.
Makes sense. So assuming this moves forward, what does it mean for specific blockchains? You mentioned Ethereum earlier.
Yes, Ethereum stands to benefit enormously. Its network is absolutely central to the current stablecoin ecosystem, hosting the majority of Tether, USDC, etc. So any positive news, even just significant progress on the Genius Act in committee, could trigger a really strong positive price reaction for ETH in the short term.
But it's not just an Ethereum story.
No, definitely not. While ETH is central, other smart contract platforms, layer 1s like Solana, layer 2s like Arbitrum, they also host stablecoins and stand to benefit significantly as regulated usage grows. It would likely lift many boats.
Okay, and connecting this back to another hot area, real-world assets, RWA. How does stablecoin clarity, like the Genius Act, specifically help the tokenization of things like bonds or real estate?
It's the missing piece, really. Having a fully regulated, compliant digital dollar is the absolute bedrock for RWA to take off at scale. Think about it. If you want to tokenize $1 billion worth of treasury bonds or a portfolio of commercial real estate, you need a reliable, legally sound way to represent the dollar value, handle payments, and settle transactions on-chain.
Right, you need the rails.
Exactly.
Yeah.
The Genius Act, by providing that clear regulatory stamp of approval for stablecoins, essentially legitimizes the primary infrastructure needed. It makes it much safer and more appealing for major financial institutions to actually start tokenizing trillions of dollars worth of traditional assets. It accelerates both DeFi and RWA adoption massively.
So, if we want to track the growth of this crucial infrastructure, what's the key metric?
You need to keep a close eye on the total stablecoin market capitalization. Right now, the report has it pegged at around $296.8 billion, almost $300 billion.
Wow.
Steady growth in that number is a direct reflection of increasing demand, both institutional and retail, for these dollar-pegged digital assets. It shows growing confidence in this foundational layer of the ecosystem.
Okay, $296 billion and growing. Noted. All right, let's bring it back to the immediate future again. Tomorrow, September 29th. What does all this mean for then? The analysis flags two major events happening that day, events that could test some of these longer-term regulatory hopes.
That's right, two key things to watch. First, domestically in the U.S., there's the SEC-CFTC Harmonization Roundtable. This is a high-level meeting. The goal is to try and figure out how these two major regulators can work together on digital assets, who regulates what, basically.
Yeah, these meetings haven't always been productive in the past, often just turf wars, right? Leading to more confusion and what's potentially different this time.
Well, the tone seems potentially different, and that's the crucial part, according to the analysis. There have been statements from the current SEC chair, Paul Atkins, suggesting a fundamentally new approach might be on the table.
Oh, how so?
Instead of the old regulation by enforcement strategy trying to force crypto into old securities laws from the 1930s, the talk seems to be shifting towards creating dedicated bespoke rules specifically for digital assets, tailored rules.
Okay, that would be a massive shift, a really positive one.
Hugely positive.
Yeah.
So tomorrow, if we see signs of genuine cooperation, concrete steps towards developing these tailored rules, that would be incredibly bullish for market sentiment. If it's the same old disagreements and conflicting signals, well, that just brings back uncertainty.
Right, a big one to watch. And the second event for tomorrow takes us across the pond.
Yes, over to Europe. We're watching the European Central Bank, ECB, Inflation Conference. The title is Inflation, Dynamics and Developments 2025. Why this matters for crypto is that central bank commentary on inflation and monetary policy directly impacts global liquidity and risk appetite.
Okay, so what are we listening for from the ECB? How do we interpret what they say?
It basically boils down to whether their overall tone, their stance is hawkish or dovish.
Hawkish meaning?
Hawkish means they're worried about inflation, signaling tighter money, maybe hinting at future rate hikes or keeping policy restrictive. That generally sucks liquidity out of the system and puts pressure on risk assets like crypto.
And dovish is the opposite.
Dovish means they're maybe less concerned about inflation, perhaps more worried about economic growth. They might signal looser policy is coming, or at least no more tightening. That generally supports liquidity and acts as a tailwind for assets like Bitcoin and Ethereum.
Okay, hawkish bad for crypto, dovish good. Got it. So, putting this all together from our deep dive today, It really feels like we're balancing on a knife's edge, doesn't it?
It really does.
On one hand, you have these flashing yellow lights from analysts like Fidelity about a potential final acceleration phase peak, bringing significant volatility risk. But on the other hand, you have these potentially massive game-changing regulatory tailwinds building, like the Genius Act, and maybe, just maybe, a more sensible approach from the SEC and CFTC.
That's the core tension right now, opportunity and risk side by side. And the analysis we reviewed strongly emphasizes that given this backdrop, especially the volatility warnings, solid risk management is absolutely crucial.
So don't chase the final pump blindly.
Pretty much. Diversification makes sense. Avoiding getting over-concentrated, especially in highly leveraged positions or very speculative altcoins, seems wise right now. And as always, none of this is financial advice. You have to do your own research, assess your own tolerance for risk against this information.
Absolutely. Which brings us to our final provocative thought for you, the listener, to chew on.
Mm-hmm.
Building on that stablecoin discussion. If stablecoin transaction volume right now already surpasses Visa and MasterCard combined, what actually happens to the speed of global finance, to capital flows, to institutional adoption when something like the Genius Act passes and fully legitimizes that massive volume, not just for remittances, but for everyday retail payments, for huge institutional wholesale transactions? What does the world look like then? The potential scale of that shift is just staggering to think about.